They don't teach this shit in school, but they should. I'm Dustin Owen, and for the past 20 years, the mortgage industry has been my classroom. I've helped over 2,000 families become homeowners, built a billion-dollar mortgage operation from scratch, and earned my way into the top 1% of income earners worldwide. Along the way, I became a real estate investor, a business owner, and have invested in over 20 tech startups, even hitting a 20x return on one of my investments. This isn't theory, it's experience. Welcome to the DO Show, where I teach the lessons life taught me the hard way. If you're thinking about buying a home, I want you to hear this first. You're not dumb for being confused. Buying a home is confusing because the system is complex, the language is terrible, and most people explaining it to you assume you already know the things you don't. And if you're a realtor or a loan officer watching this, I want you to hear this too. Most buyers don't lose deals because of price. They lose deals because of fear, uncertainty, and surprise. Something happens that they weren't prepared for. They don't understand why it's happening, and their brain fills in the gaps with worst case scenarios. My goal today is simple. I want you to understand the processes before you're emotionally invested, because once you're emotionally invested, logic becomes further. I've been in the mortgage industry since 2004. I've helped over 2,000 families buy homes. I've built teams, coached originators, run branches, and sat on both sides of the table as a professional and as a buyer/investor. So what you're getting today is not theory. It's how this actually works. And if you're a home buyer, watch this once all the way through. If you're a realtor or loan officer, share this with your buyers before they write an offer. This episode will save deals. I'm Dustin Owen, and this is the DO Show. Let's start with what homeownership really is. Homeownership is emotional first. It's identity, it's pride, it's stability. It's the feeling of, this is mine. People don't fall in love with the interest rates. They fall in love with kitchens. They fall in love with backyards. They fall in love with neighborhoods. And that's okay. But here's where people get into trouble. They treat the emotional decision like it exists in a vacuum. And it doesn't. Homeownership is also a financial decision, and a very real one. Owning a home is a liability. It comes with responsibility, it comes with maintenance, it comes with risk. And at the same time, it is still, historically, the number one wealth building tool for the majority of Americans. Both things are true at the same time. And if you can hold these two truths together, you will make better decisions. Here's something most buyers don't realize. When you buy a home, you're not just buying shelter. You're locking in a housing cost in an inflationary world. Rent is a variable expense forever. A fixed mortgage? Not so much. Even if taxes go up, even if insurance rises, your principal and interest payment does not change. That matters over time. Another thing buyers misunderstand, you are not choosing a home for 30 years just because the mortgage is 30 years. Most people refinance. Most people sell. Most people move. Statistically, homeowners keep a mortgage about 5 to 7 years, and they stay in the home about 7 to 9 years. That means buying a home is usually a 5 to 10 year decision, not a lifetime sentence. And once you understand that, your financing choices change. Which is why we do not start with houses. We start with money. So let's jump into why financing comes first. The first step in buying a home is not Zillow. It's not open houses. It's not Instagram reels of kitchens. It's a conversation with a financial professional. Even if you're paying cash, you should talk to someone who understands money. And if you're not paying cash, which most people are, you need a mortgage. A mortgage is not a product, it's a strategy. And a good strategy considers more than just payment. It considers things like how long you plan to stay, how stable is your income, how much liquidity do you want to keep, what risk are you comfortable with, what flexibility may you need later. One of the biggest mistakes buyers make is asking the wrong question. They ask, what do I qualify for? Well, that's the base question. The better question is, what fits my life? Because the bank will often approve you for a payment that makes you house rich and life poor. So the first conversation is about alignment, not approval. And this is where pre-qualification begins. A pre-qualification is a conversation. You're talking through income, debts, savings, and comfort level. The lender is building a picture based on what you say. It's directional, it's helpful, but it's not final. A pre-approval is different. A pre-approval is when we, the lender, it's when we verify. We pull your credit. We document your income. We review your assets. And your information is typically run through some form of an automated underwriting system or underwriting logic. This is the difference between a weather forecast and a radar image. Pre-qualification, well, that's a forecast. Pre-approval, that's a radar image. Both are useful. One is more precise, and sellers care about precision. Now let's talk about eligibility versus qualification, because this matters. Eligibility means you fit the definition. Qualification means you fit the math. You can be eligible for a VA loan and not qualify. You can be eligible for down payment assistance and not qualify. You can be eligible for FHA and still not qualify. Qualification happens when real numbers meet real guidelines. And that's why pre-approval protects you emotionally, because there's nothing worse than falling in love with a home you can't buy. Now let's look at how lenders actually evaluate you. When a lender is evaluating you, they are answering three questions. Can you repay the loan? Will you repay the loan? And is the collateral sufficient? Income answers, can you? Credit answers, will you? The house answers, is it worth it? Income is not just about how much you make. It's how much of your income is going to be usable based on calculations. Salary is different than hourly. Hourly is different than commission. Commission is different than self-employed. And self-employed is different than investor income. This is why two people who make the same amount of money can qualify very differently. It's all based on how much you can document, how much you can prove. Credit is not about being perfect. It's about patterns. Late payments matter more than balances. Consistency matters more than spikes. Recent behavior matters more than old mistakes. And assets are not just about how much money you have. They're about where it came from and whether it's available. Large deposits, well, they get questioned. Transfers, they get traced. Gifts, gotta document them. This isn't because lenders are mean. It's because after 2008, rules changed and documentation protects everyone. Now let's jump into loan programs. Now this is the part that most people kind of understand, but not enough to make confident decisions. Because the internet talks about loan programs like they're menu items. They're not menu items. Loan programs are risk buckets. Each program exists because lenders are trying to answer three questions. Can you repay? Will you repay? If you don't repay, is the collateral good enough to recover? That's the game. So I'm going to walk you through the most common programs, and I'm going to explain them the way professionals think about them, not the way TikTok explains them. And if you're a realtor or a loan officer watching this section is your script. This is how you explain loans to buyers without confusing them. We'll start with the most common loan program, and that's the conventional loan. Conventional loans are the standard issue mortgage in America. They follow guidelines set by Fannie Mae and Freddie Mac. Here's why that matters. When a lender makes a conventional loan, they have a high probability of being able to sell the loan into the secondary market. That liquidity is what keeps rates competitive and keeps the machine moving. What conventional loans are best for? People with clean, documentable income, predictable assets, and credit that falls within standard guidelines. What conventional loans can be used for? Oh, they can be used for a primary home purchase, a secondary home purchase, which secondary homes are vacation homes. They can be used for investment properties. And yes, they can even be used for multi-unit properties. That's 1 unit, 2 unit, 3 unit, and 4 unit. And here's an important truth most home buyers miss. If you put less than 20% down, conventional loans typically come with mortgage insurance. By the way, that means you can put less than 20% down and qualify for a conventional loan. And it's not bad that conventional loans are going to have mortgage insurance if you put less than 20% down. Listen, you're buying a home with less skin in the game. The lender is reducing risk by insuring the loan against your default. For example, if you put 5% down on a conventional loan, you're going to have to pay mortgage insurance. Now, you could pay it monthly, you could pay it all up front, or you could even finance it into your interest rate. But unlike an FHA loan, the mortgage insurance on a conventional loan can be removed at some point once you have enough equity. It's good to know that conventional loans have loan limits. And in most areas, the current conventional maximum loan size has recently gone up to $832,750. Now, if you're in a high-cost area, let's say San Francisco or New York City, it can go as high as $1,249,125. That matters because it determines whether your loan is conventional or whether it becomes jumbo. Now, let's go to the program that most people should understand, especially veterans. That's a VA home loan. I love VA home loans. If you qualify for a VA loan, it is one of the most powerful financial tools in the entire mortgage ecosystem. And I'm going to say something loud. VA loans are not hard loans. VA buyers are not weak buyers. VA loans are not a pain in the rear. That narrative exists because a lot of people repeat things they heard from someone else, who heard it from someone else. Here's what a VA loan is. A VA loan is a mortgage program backed by the Department of Veterans Affairs that allows a qualified veteran or active duty service member to purchase a home with favorable terms. What a VA loan is best for? Buying a primary residence with high leverage and strong long-term affordability. Why are VA loans so powerful? Well, they offer 0% down. That means you can preserve cash. Cash is oxygen. No monthly mortgage insurance, and that's huge. You might pay a funding fee unless you're exempt due to disability, but you typically avoid monthly mortgage insurance. It has flexible underwriting. VA loans focus on sustainability, and that brings us to one of the most important things about VA that almost no one talks about: residual income. Residual income means after your mortgage and your other obligations are paid, does your household still have enough breathing room to live? It's a guardrail, and it's one of the reasons VA loans can be incredibly responsible loans, not risky loans. Here's an example. Two borrowers both make $120,000 a year. Borrower A has 2 car payments, student loans, and a revolving debt. Borrower B has lower fixed obligations and better cash flow. They might both qualify under standard debt ratios, but VA residential income may differentiate whether the loan is sustainable. Now, here's the practical advice. If you're a veteran, a VA loan can be your first home. It can also be used later again. It can be a part of your wealth strategy, not just your shelter strategy. If you're a realtor, stop treating VA offers like second class. A well-qualified VA borrower with a strong lender is often more solid than a shaky conventional borrower with thin cash reserves. Before we get to FHA loans, let's talk about jumbo loans for a minute. A jumbo loan is what happens when you go outside of the maximum loan sizes that are allowed by conforming loan limits. A jumbo loan is not a special type of borrower. It's a special size of loan. It's your loan amount, exceeding the conforming loan limit for your area. The minute that happens, you're in jumbo territory. And jumbo loans are best for high-income, high-asset borrowers buying high-priced homes, usually primary or second homes. Why jumbo is different is because lenders can't rely on the same cookie-cutter liquidity system. Jumbo loans often stay with the lender longer and require different secondary market strategies. So the lender protects themselves by tightening rules. What that means in real life, you may need more money down. You may need more reserves, which is money left after closing. You may need stronger credit. You may need a lower debt-to-income ratio, and the underwriting may be more manual and therefore detail-oriented. Here's an example for you. If you're buying an $800,000 property, you could easily put 5% down in many scenarios and go conventional. But the minute that sales price becomes $1 million or $1.2 million, now you're going to have to put down 10, 15, and sometimes 20%, depending on the profile and loan structure. Why all of this matters? Well, it matters because buyers often shop homes first, then discover they just crossed the jumbo line and now everything changed. So if you're a buyer in a high-cost market, your lender should be saying, here's the conforming loan limit. Here's the threshold where we cross into the jumbo space. Here's where the pricing changes. Here's how we keep you in the best lane. That's what good looks like. Real quick, let's talk down payment assistance, also known within the industry as DPA. Down payment assistance programs are real, and they can be amazing. And they can also be misunderstood because people hear down payment assistance and they think, oh, free money. No, that's not how it works. Look, sometimes it is. Sometimes it's a forgivable second loan. Sometimes it's a repayable second loan. Sometimes it's a grant with rules. Sometimes it's a loan with its own payment. You don't need hype, you need clarity. What down payment assistance is best for? It's helping buyers with stable income who can afford a mortgage payment, but who don't have enough cash saved for upfront burden. What does DPA do? Well, it helps cover the down payment and sometimes a portion of the closing cost, depending on the program. The two concepts everyone needs to understand, and we talked about this a little bit earlier, is eligibility versus qualifying. Just because you're eligible does not mean you qualify. Many programs have income limits, purchase price limits, geographic limits, education requirements, minimum credit score requirements, reserve requirements, layered underwriting rules. We call those layered rules overlays. Here's an example. You might qualify for FHA with a certain credit profile, but the Down Payment Assistance Authority may require a higher score, a lower debt-to-income ratio, or additional reserves. So it's not the lender being difficult, it's two sets of guidelines stacked on top of each other. And here's the big truth. Down payment assistance can be a fantastic bridge, but sometimes it comes with a trade-off. Slightly higher rate, additional fees, second lien terms. A second lien, by the way, is a second loan. So you want the lender who can say, here are three options. Option A, down payment assistance. Higher rate, but less cash needed. Option B, no down payment assistance. Lower rate, but you need more cash at closing. And option C could be a hybrid. That's how you teach adults. You give them choices. We haven't covered non-QM loans yet, so let's go ahead and do so. Non-QM does not mean it's a bad loan. It means non-qualified mortgage, not fitting the standard qualified mortgage box. The QM box exists because after 2008, regulators wanted stricter definitions around ability to repay. So non-QM exists for people who are financially strong but don't look normal on paper. Who non-QM is best for? Self-employed borrowers, 1099 contractors, business owners who write off a lot, real estate investors, borrowers with complex income streams, borrowers buying unique properties. Let's talk about the main flavors. Bank statement loans first. These are for borrowers whose tax returns don't reflect their true cash flow. because they run legitimate deductions. Instead of using tax return income, a lender uses bank statements or bank deposits, usually 12 to 24 months worth of statements or 12 to 24 months worth of deposits to calculate usable income. Here's an example. A self-employed contractor might gross $300,000, but show $80,000 taxable income after expenses. Conventional looks at that $80,000 and says, you qualify for less. Bank statement looks at deposits and says, your cash flow supports more. The good news with a bank statement loan is, well, you now qualify for the home you desire. The bad news, you may have a slightly higher interest rate. You're probably going to be required to put more money down, and a bank statement loan will have higher credit requirements. The next drug of choice, when you're talking non-QM, is DSCR loans. DSCR stands for Debt Service Coverage Ratio. Translation, the property qualifies itself. Instead of your personal income, underwriting focuses on whether the rent covers the payment. Here's an example. If the rent is $2,500 a month and the full housing payment is $2,000 a month, a DSCR loan may work because the property cash flows enough to cover itself. These types of loans are great for investors, whether you're buying a short-term rental or you're buying a long-term rental. Investors who don't want to show personal tax returns for qualification, they can scale portfolios using a DSCR loan. Also common are P&L loans or profit and loss loans. Some programs use profit and loss statements, often working alongside a CPA, to validate income. Again, this type of loan offers flexibility, but it's going to come with a price. Where people mess up with non-QM is they shop purely by rate and then get shocked by down payment or credit or even interest rate requirements. Non-QM is not cheap money, but it is possible money. Now, there's two loan programs we haven't covered yet, and one of them is the second most popular ever. It's an FHA loan. FHA loans are not just for first-time home buyers. Now, I repeat, they are not just for first-time home buyers. Now, because they end in A, it makes them a government loan, just like VA, FHA, and the next loan program I'll tell you about, USDA. All three of those loans are government-backed, and all three of them can only be used to purchase primary homes. Unlike a jumbo loan, unlike a non-QM loan, and unlike a conventional loan, where you can use those types of loans to buy vacation properties as well as investment properties, you are not going to use an FHA loan to buy a secondary residence or to buy an investment property. You're only going to use it to buy a primary home. Now, FHA has their own maximum loan size, and it is typically less than what conventional allows. So there are times you may have a perfect FHA borrower or a perfect FHA scenario. However, if that loan size is $600,000, $700,000, or $800,000, it might not be eligible for an FHA loan. Now, I love FHA loans because they allow for someone to put down as little as 3.5%. Unlike a conventional loan, FHA does have what's called upfront mortgage insurance. The good news about upfront mortgage insurance is it's not paid by the home buyer out of pocket, but it is rolled into their loan, which means they end up financing a few $1,000s more because of that upfront mortgage insurance premium. And as we discussed earlier, under the conventional financing section, conventional mortgage insurance can be removed, where currently you cannot remove FHA's monthly mortgage insurance. And when you're an FHA borrower, you will be paying some form of monthly mortgage insurance. Now, FHA tends to be a lot more flexible when it comes to heightened debt income ratio and credit blemishes than conventional financing. It is a phenomenal loan program, not just for first-time home buyers, but for anyone looking to purchase a primary home. And another misconception is someone thinks that just because they used FHA on a previous home purchase, that they're not allowed to do it again. That's not the case. You can utilize FHA financing multiple times throughout your lifetime.
Okay, good.
And then lastly, to round off all of the various loan products, there is something called a USDA home loan. USDA is United States Department of Agriculture. It is a 0% down loan program. Now, because it ends in A, it means it's government backed, which means, again, it's only going to be eligible for people who are purchasing a primary home. USDA is only for homes that are in areas deemed to be rural, and they have maximum household income limitations. If you are in a more rural area and you are looking for a loan program with minimal money out of pocket, you should 100% look at a USDA loan. Now let's walk you through the actual home buying steps. And I'm going to explain what each step is, why it matters, and how to do it the right way. Because most buyers only learn this stuff while they're in the middle of it. And that's like learning how to swim after you jump into the deep end. Not a good idea. Step one, your very first step is you want to do a home buying consultation with a local trusted lender. Right? This is a conversation with a lender where you define your real goals and get an honest plan. This matters because you don't want to shop for homes with fantasy numbers, and you don't want to base your biggest purchase of your life on an online calculator that doesn't know your credit, your income, your goals, or your risk tolerance. You want to know how to do this really well? Bring your reality, bring your questions, bring your fears, bring your budget. And if you're a buyer watching this, tell the lender what you actually want. For example, DO, I want a payment I can afford even if daycare goes up. Or I want to keep cash reserves because I'm commission-based. Or maybe you'll say, I'm okay with a slightly higher payment if it means I keep $15,000 in the bank. Step two, actually get pre-qualified. Right, a pre-qualification is an early estimate based on what you tell the lender. This matters because it sets boundaries before you fall in love with the wrong price point. And be honest about your debts, your monthly budget, funds for closing, income type, job stability. For example, if you say you have $20,000 saved, but half of it is really your emergency fund, tell the lender that, because you don't want to drain your safety net to buy a house. The third step is you need to turn your pre-qualification to a pre-approval. A pre-approval is where you get verified. It's where your lender pulls credit, they review your income and your asset documentation, they apply their underwriting logic. And this matters because sellers and listing agents care about certainty, and you care about not wasting time. So get organized. Be ready to provide 30 days of pay stubs, 2 years of W-2s, potentially, especially if you're self-employed, 2 years of tax returns. You're going to need 2 months worth of bank statements plus an ID, and you're going to need to explain anything that's deemed unusual. And please, don't take it personally. Underwriting is not judgment. It's documentation. Step 4, have a home buying consultation with a trusted local realtor. Most people want to make this step 1. Not so fast. In reality, it is step 4. So what are you going to do? You're going to meet with a realtor so that you can formulate a strategy and execute a plan so you can search and negotiate for the right homes. This matters because the agent is not just unlocking doors. A great agent helps you set realistic expectation, understands neighborhoods, manages negotiation, protects you from emotional decisions, guides you through contract timelines. And how do you know if you're with a great agent? Tell your agent your non-negotiables and your fears. And how do you do all this successfully? It starts with you telling your agent about your non-negotiables. Share with them your fears. For example, safety matters, commute matters. I can compromise on countertops, not school zones. Now your agent can guide you. Step 5, well, with your agent's help, set up your search criteria. What is it that you're looking for? This matters Because if you don't filter, the market will emotionally exhaust you. You'll tour 20 homes, hate 18, and then panic buy number 19. If you want to do this well, do this. Create 2 lists. One list is a list of non-negotiables. The other is a list of wish lists. And here's the rule. The right home has all of your non-negotiables and at least half of your wish list. An example would be non-negotiables: 3 bedrooms, safe neighborhood, under 35-minute commute to work. Wish list: pool, updated kitchen, corner lot, bonus room. If it all hits, amazing. But ideally, you'll have all your negotiables and just half of your wish list. Step 6, tour the homes. This is the fun part, but it's also the reality test. It matters because pictures lie, and your brain creates fantasy from listings. If you want to do this well, tour with intention. Ask questions like, what's the age of the roof? How current is the HVAC? What's the neighborhood like after 8 p.m.? What does the street sound like? Where's the nearest busy road? And try to keep your emotions in check. Love the home, but don't fall in love with the transaction. Step 7 is negotiate an offer. Right? This is where you're proposing terms, not just price. And it matters because the best offer isn't always the highest. Sellers want a strong approval. They want clean terms. They want confidence you'll close. They want a timeline that fits them. And you'll do this really well when your lender and your realtor are working together. For example, if the seller wants speed, a 30-day close might win. If they need time to relocate, a 45-day close might win. Terms win deals. Remember that. Terms win deals. So let's talk about a 30-day close. The what, the why, the how, the timeline, heck, the reality. Because this is where anxiety kicks in for most buyers. So you signed a contract, you think, cool, I guess I don't know, show up and get the keys in 30 days? Nope, that's not how it works. A 30-day close is a coordinated sprint involving you, your realtor, your lender, your processor, the underwriter, the title company or closing attorney, the appraiser, your insurance agent, sometimes the homeowners association. In many cases, it includes your employer, the IRS, your banking institutions. So check this out. Day 1, the contract got signed. Here's what happens. So contract was negotiated, you signed it, seller signed it, and now you owe the seller some kind of a security deposit, also known as an earnest money or an escrow deposit. This matters because it shows the seller you're serious. It's a good faith deposit. You usually would wire this money or you'll deliver it per the instructions on the contract. Now, once your contract is signed, in those first 5 days, you're going to want to get your home inspection if you're opting to get one. And we normally advise you to get a home inspection. Now, a home inspection, that's your exit ramp if something major is discovered. If the home has significant undisclosed issues, you want to find out early before you spend money on an appraisal, before you waste time on underwriting and everything else that gets deep and expensive. So pick a good inspector, show up, ask questions, learn the house, and listen. Now, every inspection report looks scary. Every house has issues. The question is, are they normal issues or are they deal-making issues? Now, once you've been given your options and your lender has locked in your interest rate, they will then disclose your loan file. After disclosure, they're going to order your appraisal, title, and need you to go get an insurance quote. Now, the lender orders the appraisal. The title is ordered through a title or escrow office, and insurance is typically gathered by you or the processor. Because the lender needs to confirm value in the legal status of the property, title work answers, does someone else have a claim to this home? Are there liens? Are there title issues? Insurance, well, can the property be insured and at what cost? Because that cost factors into your payment. That payment factors into whether you qualify. You can shop for insurance early, so don't wait. insurance can actually derail affordability the quickest. Now, on days 7 through 14, your file is going to be submitted to underwriting. What happens is this. Your processor organizes the file and sends it off to underwriting. Because underwriting is the risk gatekeeper, they're verifying that the file meets the rules for the loan program that you have chosen. They're not trying to kill your deal, I promise you. They're trying to make sure the loan is legal, documented, saleable, and has low default risk. Your processor may request conditions, quote unquote, even before underwriting. That's a good processor. In conditions, it's just additional documentation. Now, after the file has been initially underwritten, the underwriter is more than likely going to approve your loan, but they approve it with conditions. And that's because most loans almost always require clarifications. A condition might be updated bank statement. It could be an explanation letter for a recent credit inquiry. It could be proof that a deposit has cleared. It could be a verification of employment, or it could be documentation of a gift that you received or proof that a debt was paid off. When you are requested this type of information, our suggestion is respond fast. Don't take it personally. Don't disappear. Deals die from slow communication. Now, at days 18 through 24, this is when your conditions will get cleared and you'll submit for final approval. What happens is that the processor resubmits the file with conditions. The underwriter clears the remaining items. And this has to happen because the lender needs a clean file to issue the clear to close. 3 words that you love to hear as a realtor, a lender, and a home buyer. This is where boring behavior matters. Whatever you do, do not open new credit cards. Do not buy furniture on credit. Don't go financing a car, quitting your job, starting a new company, moving money around, no large deposits. Just keep things normal. But if you do, please know you are creating new questions. In days 24 through 27, this is when you would expect to get your clear to close. This is when you'll get your final figures needed at the time of closing. What happens is this. The file moves to a closing department. The title company and the lender coordinate final closing disclosures. You receive a final funds to close or cash to close number. All of this is happening just days before the actual closing. And this matters because numbers can change slightly based on final taxes, insurance, credits, prorations, and title fees. You will end up wiring funds per the instructions given to you by the closing attorney or the title company. Verify those wire instructions with a phone call because fraud is real. Now, in those last couple days leading up to the closing, this is when you want to schedule a walkthrough with your real estate agent so you can walk through your property to make sure nothing has changed since you last were inside. You will also want to start reaching out to all the utility companies so that you know that the utilities will be turned on the day that you take over ownership. Now, let me normalize a few things that freak buyers out. Underwriting asking for more docs is normal. Appraisals taking time is normal. Title issues can pop up, but they're usually fixable. Your cash to close number changing slightly is normal. The process feeling quiet for a week and then chaotic, that too is normal. You're not crazy. You're just in a system that runs in phases. Listen, buying a home doesn't have to be overwhelming, but it does require education, strategy, and the right professionals. If you're a buyer, click the link in the description for a free consultation with a TLOP-approved professional. If you're a realtor or a loan officer, share this episode. It makes you instantly more valuable. And if this helps you, subscribe to the channel. Or if you're listening on Spotify or Apple, give us a 5-star review. Share this with someone who needs it. I'm Dustin Owen, and I thank you for tuning into The D.O. Show.